Hello and welcome to Jim Dalton's presentation, Fresh Start for the New Year. This is the second webinar of two in a series. It's January 11th, 2016, currently 9:01 a.m. Eastern. Jim and I want to thank all of you for being here. Fabulous to see you. Take time out of your busy lives to spend it and give us the opportunity to share Jim's work with you. So thank you very much. We will take questions as time allows. Please type them in. This webinar is being recorded. We'll have it uploaded for you not long after this webinar is over. We'll put it on YouTube and Vimeo as well, so whatever works for you, we'll have it there for easy access. Also, there are two reports that were furnished as handouts in this GoToWebinar. Hopefully you can see them all there. Or you're welcome to go to J. Dalton Trading. Hopefully you can download them through this GoToWebinar new feature they have. We also have the intensive schedule. We have 51 webinars slotted for the upcoming Legacy 1 series intensive that starts next Tuesday, January 19th, and it will continue for 5 weeks until Tuesday, February 23rd. That's to accommodate the two U.S. market holidays that fall in that time period, so we get a full 5 weeks. So please check that out as well. If you can't, for any reason, download those reports in the intensive schedule, you can go to jdaltontrading.com and under Resources, Webinars, Upcoming Webinars, the two reports are there for you to download. That's where you'll also, well, close to that, access the recorded webinar, and also at the Legacy series under Work With Us, you will find the intensive schedule. Okay, so thank you everyone for being here, and without any further delay, I will say hello and turn it over to Mr. Dalton. Hi, Jim.
Well, good morning. Good morning. I'm going to start off kind of where we are right here. Then I'm going to go backwards. I'm going to pull up one of the reports from the weekend, and I'm going to kind of work backwards on that. The most relevant thing for very short-term traders is I want to go back and talk about Friday. Friday was, again, high volatility day, and it was a very difficult day to trade because of the volatility. One of the things that I want you to notice is F period high, and the market one time frame lower from F period through the close. One time framing, just in case there's any question, it means that, hold on just a sec.
While Jim catches his breath there, one time framing means that the high of the current bar does not take out the high of the previous bar, so you can see G period falls short of F. H period cannot take out the G period high. I period cannot take out the H period high. And you also notice I period did not take out the low, but that still technically keeps this market one time framing. And it proceeds all the way into the close. And Jim, are you okay?
I am.
Okay, that's it. Thank you.
And I had, for those that get the reports that I've been sending out that are part of the intensive, for Thursday's trade, I pointed out also the importance of one time framing. And the market did not have high confidence on Friday, and it didn't have high confidence because of the way it traded. If high confidence, you'll open and you'll go steadily lower. We were back and forth, high volatility, so it was not high confidence. So that's one of the things I record early. But then, when the market rallied in F period, it then started to one time frame lower the rest of the day. It didn't change unless you had your profiles split out like I have here, or you have 30-minute bars and you have those split out. It is very easy to mask what is really going on in the market. It's very easy to miss that, and then it's very easy to start buying breaks. Traders, particularly traders that have trouble mastering the market, have a strong tendency on a day like Friday to buy the lows several times. And at that point, when that happens, it can get very expensive. Now, I did buy the low. One time. I bought when E period took out the previous day's low and came back in. I did go long the market. That's one of my favorite trades. Then the market did rally from there, and we got all the way up. But from that rally, it started to one time frame lower. Now the tendency traders have is because it bounced from around Thursday's low, when it comes back down there again, they have a tendency to want to buy it again. And that you'll see there was some rally out there. There was some of that going on. So you got some short-term reward from that. But notice that there really wasn't any lift. What was going on in the afternoon, the market was, look down below this, there was some buying because it worked in the morning. And then the market went up and people were selling into that the entire time. And that was an easy trade. It was an easy place to get lost or to do the wrong thing simply because the market was going lower, and it does appear to be attractive sometimes. If you, however, had the one time framing, the market spread out, and you could see it's one time framing lower, you had a much better perspective of what was going on Friday afternoon. Okay, any questions on one time framing or what I see for Friday afternoon? Just on that. Any questions on that before I go to the next point?
No, Jim.
Okay.
Hold on one second. Let me just. Okay, we'll get to that.
Okay.
The questions. Keep going, sir. Thanks.
Okay. Now, also notice at 1936, I believe that's 25. That's the point of control. The point of control is also defined as the fairest price at which business is being conducted. It generally, when people start to trade and sell the market below the point of control, they are selling at poor prices, or they are doing what we call getting short in the hole. Now, sometimes a market will just, it's been a market that everybody has made money by selling the market, and it's gone straight down, and people keep doing that. When you put together the fact that the point of control wasn't going lower, then I say, okay, I see what they're doing, and this is what they're doing for the afternoon, and they're going to keep doing it. And particularly Friday afternoon, nobody wants to step in front of the market. Come a long weekend, or I'm sorry, not a long weekend, but a weekend. Also, you have an options expiration almost every Friday now. But they were getting the market caught short in the hole. And so at this point in time, I can see this is going lower, but I have no interest in going lower with it. Not that it wasn't a good trade, it's just that the risk is very high. Now last night, remember the point of control did not migrate lower. Late in the day, this is called a spike. The M period, and it broke when it took out the L period low, and it happens late in the day. The market spikes down. It was 1923.25, and this late spike, we don't have enough time to know if that spike was legitimate or not. Is it going to be accepted or is it going to be rejected? So we have what we call the spike trading rules, and the spike trading rules are very simple. If the most negative thing that happens, the market on Monday morning, in this case, opens and stays down below this spike, it's very negative because it tells us that the market had not gone low enough to cut off the selling. The most bullish response is if the market opens above this spike. If the market opens above this spike, then we have the potential for an excess low. Excess is one of the two most important concepts we deal with in the market. Excess and balance are the two. Excess marks the end of one auction and the beginning of a second auction. So now on Sunday night, the market, immediately opens, and people that are following price, let me spread this out. Think about all the non-thinking traders in the world. All they have to do is sell. Sell, 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 because that's what's working. So again, the market opens on Sunday night, and what do traders do? They sell off. They continue to sell it off immediately. Additionally, China is lower. That happened a little bit after our opening. Now, Julie, I believe you have a question there that we said we would answer once the seminar or the webinar started this morning.
Yes, sir, and I have a couple other questions, but we'll just keep going with the flow here. Seeing that it looked very short, when the ES was near the overnight lows, I bought a call. Is it better to buy in the money, at the money, or out of the money calls? Or does this depend on my risk tolerance? There's a second part of the question, so if you want to
it's a great question. Yes, it depends on your risk tolerance, which is a great answer. I did the same thing. I bought way out of the money calls, and I bought all the way up. I bought the 70s, the 1970s, which is way, way up.
Holy, how much you pay for those?
They paid $4. Okay, and what I was looking for, the reason I did that, and I'll come back to the original question. The reason I did that, I think the market is very short, and I thought I had a chance to maybe go a little larger than I might go sometimes, and looking for something that was, maybe a real move during the week.
You mean
the other ones I look
size? Excuse me.
Larger rally, because the market is. There's so many things about this market that tell me it's very short. But
gotcha.
Yes, it is a personal question. What I don't do is I don't buy one. And the reason I don't buy one, it doesn't give me any flexibility. Sometimes I like to have a greater number, so that I can, for example, if you're going to go long calls, if there's points in the market, I may want to go short in some mix, not 100%, versus the number of calls. But if I want to go short some calls, short some futures against the calls, I can do that. It gives me somewhat of a trading opportunity. But the question is, do you want to go in the money, out of the money, or way out of the money? I would suggest that at a minimum, you go slightly out of the money. When you're looking for this situation, you want some leverage. You want to reduce your risk if the market really craters. And the reason I wouldn't do futures down here, because I have no idea if something really crazy can go on in these markets. The options give me a little bit more security in the trade. Then the question becomes, do you take profits? Do you let it go, etc.? Well,
can I ask his question just so it's voiced for that? That's the second part of his question.
Okay, go ahead.
We can move on. As we appear to be gapping up, would you close the call and take profit, or keep it and monitor for continuation, thinking the Friday sell-off traders are overly short?
Yeah. I would keep it at least until I saw what happens on the opening. And the reason being is that the market is very short in here. So I don't know what can happen when the shorts are out there. The market can go a long way. But another reason for having multiple ones would be to be able to let some go, take some off the table, so that you ideally have your risk covered in there. So ideally, I would like to take some off the table. I would like to keep some on. Okay, but it's a good question, and I think that is exactly the time, the situations where I like to use options. I think the risk reward is very attractive. They're not going to price out. They're not going to price out well on models and stuff like that. I'm just looking to say, what do I think could happen in this market? Okay, now go back, and we're talking about monitor for continuation. We talked about the spike, and we have the spike.
That profile, excuse me, Jim. Collapse it so we can see the spike, and that one too. No, you just You have to cancel it to get rid of the lines. You just click cancel on the overnight there and the other. That way we can see the spike a little easier. Make it a little smaller so we can follow along visually for those not familiar. Excuse me and thank you.
Okay, so here's the top of the spike, 1923.25, and we've got about 15 minutes till the opening. We are currently trading above the top of the spike. So the most bullish scenario would be to open and remain above the top of this spike this morning. Now, where traders also get in trouble, everybody's made money by selling every rally. What you have to appreciate is how deeply short this market might be. Well, it is very short. You don't know how many people are going to be forced to cover. I'm going to go over and I'm going to pull up a prior report. Not a prior report. I'm going to pull up the report we used over the weekend. Before I go any further with this, there's one point I meant to make and I didn't. On Friday afternoon, we were one time framing lower. At the same time, I pointed out that the point of control was not migrating lower. Remember, the point of control is the fairest price at which business is being conducted. So when the selling takes place below the point of control, people are getting short at prices below value for Friday. So I was looking at two time frames. I was looking at the day time frame, which was taking the market lower, but I was also making an assessment for the next higher on the next time frame or Monday morning, saying, yes, it's going down right now, but at the same time, they're getting themselves in a potential difficult situation. So Friday, it was clearly going lower. I didn't question that at all, but I was sitting saying, I was questioning, is there going to be an opportunity on Monday or Sunday evening? So you're fighting cognitive dissonance. You're saying there's two things going on. One, it's getting too short right now. What may that mean going forward? Okay.
Can you just maybe leave that open and just, or you want to talk about something else? Because we have a few questions I want to get to before we hit the open.
Okay. Back where you see the red line, the market sometime back had been going lower. We had three gaps that were fairly close together. I was writing as we got near the third gap, I hadn't seen a break like that in a long time. Not the range, but leaving the spike, leaving the gaps. And I was cautioning that that is a very dangerous situation, market dangerously short. This is the rally that followed those comments. It didn't happen that day, it happened the following day. But this is what happened when the market gets really short. It just starts to feed on itself, and then it kicks in, and the momentum buyers come in, and you can see it carried that market a long way. Coming into today, we only have two gaps. There's almost three. This is an almost gap. But when we opened last night, we had the potential for four gaps. So that gave me more desire to want to buy calls last night. But we're going into this was very thin going down, and with this very thin going down, it can come back up through this very quickly, and the reason being there's no backing and filling. Go ahead with your questions, please.
Thank you, sir. Could you show the spike low? We have a question. I hadn't perceived the spike as a legitimate spike because of the poor low, and given end period, pulled back to the high before it closed. Pullbacks to its high, but that's a priority of observations too. There's hierarchy, right, Jim? I mean, that could also mean the market got too short.
Happened. That happened. After the NYSE close. Also, I have made the comment for those that have been with me a long time that sometimes poor highs and poor lows can be an indication the market's too long or too short. And that cost me a lot of money when I first started trading. So you have to always put everything in perspective. I did take it as a spike. Okay, another question.
Yes, thank you, Jim. You mentioned the one time framing in the afternoon. Maybe you could split that profile again and discuss the one time framing in the morning. What about that one time framing?
Yeah, the market started down in the morning, one time framing lower, and that's great.
Right, and you
Pardon?
didn't touch it. Pardon me, I don't mean to interrupt, but you didn't touch it until we had the signature trade of coming back in range in E period. So you were holding to that theory that, you weren't going to step in front of that.
No. I didn't say anything wrong with going short on. No,
I'm
I didn't
saying
say anything wrong.
fading it, going against and going long. You didn't take your long until you had an excess low and it came out of the range and came
That's right.
back into the range.
I missed the initial break in the morning. Then when the market rallied back up and left a weak high. That allowed me a chance to get back into the to the market. But it's what is important is the market was one time framing lower in the morning. It got down below, and there were several rallies in here that told me confidence wasn't high. Got down below the previous day's low and came back in. When that happens, this is one of my favorite trades, because in a sense, remember earlier I said the two most important concepts we deal with are excess and balance. In this case, the market tried to go out of balance.
Could you slide it up a little so they can see that excess low all the way? There we go.
It tried to go out of balance relative to Thursday and failed. When it came back in, that qualifies as one of our signature trades. It's an asymmetric opportunity, and that's a good trade to take. And now when it comes back in, and it rallies pretty strongly, and at that point in time, you don't take the high. There's a lot left on the high. It didn't get back to this earlier C period high, and at that point in time, I just kind of move aside. Now you got a G period inside bar. Inside bar is another form of balance. So another opportunity on the downside was to go with the breakout from the inside bar. Now, it would have been a tough trade because it did break out, but a lot of times when you do that, the stops back up in here, and you might have gotten stopped out because of the I period rally back up into this. But this is a signal for the trade. When you come out of balance, to the downside, that is an indication that change has taken place. One time framing has stopped, and the reason we look at things like that, trading is about change, and we're looking for indications that there is some change in what is going on, what we'd seen earlier in the morning. We stopped one time framing, and it wasn't just by a few ticks, it was serious stopping of one time framing. Then we had an inside bar, then we broke in I period, then we broke again to the downside. But this still could be very confusing because of the volatility. I period came further back in than you would have expected. J period comes back in. So in one aspect, this was a very, very tough trade. It may look easier now. What helped me was the fact that the market was continuing to one time frame lower. If you didn't have your profiles spread out, you might not see that. And that's the importance of understanding. So many times we get too focused, too tightly on very short-term price information. That could have easily misled you on Friday. Opening up just a little bit to see the one time framing said there's just no let up in this market.
Okay, Jim, could you collapse that for a second, please, and just make it a little smaller so we can see more of the profile? It's very hard when it's so large to make any sense of it. So we have a question. Did you not call the price action on Friday and the structure shape a 45 line because there wasn't enough rotation back to the point of control. Why, did you call it a 45? I thought you did. You didn't call it
I
a
didn't.
45, but you
I
drew the
didn't. I
arrow.
didn't.
Right.
I didn't use the definition 45-degree angle or 45-degree line. But on the report that came out, I showed that outline. I drew the arrow from the low to the point of control, and I clearly made the point that prices were being sold
Okay.
in short in the hole.
Okay. That's great, Jim. I'm sorry. Could you split that out? We have a question. I'm just trying to fit a lot of questions in here. Split out Friday's profile, and we have a question on the rally high. We got 4 minutes till the open. Thanks for asking this. Is the rally high at 1943 on Friday a legitimate reference point for any rally? We always talk, just for context, we talk about the rally high, that if a market's fading like it did and going down on Friday and we cannot get above that rally high, just using it as a line in the sand and keep ourselves straight, there is no change in the market. And so we'll often use rally highs or pullback lows on opposite, trending up days as fulcrums if there is, quote, change in the market. So the question is this rally high an important reference point for you this morning?
The 1943, I think that's 1943.25.
Yes.
And so, yes, it is a reference, but it's not the most important reference point to me. The most important thing to me this morning, and I take it a piece at a time, the most important thing to me this morning is the top of the spike, which is at 1923.25. It's the top of the spike. I know the market was short. I mean, that's what I wrote up over the weekend. I thought the market's been short for the last few days. And so when I take it a step at a time, one, I want to stay above the spike. Two, I want to get above the overnight high. Then my next objective is going to be half back from Friday, which is right there at 1931.75.
If you collapse it, they'll see it. I'm sorry, sir. I don't mean to interrupt.
Half back is going to be right here at the 1931 area, 1931.50. Then my next is going to be the point of control. So I take these references and I just treat them one at a time. I'm not ready to jump all the way up to the 1943 reference. Yes, if we get above that, clearly there's huge change going on in the market. But right now, I'm going to take it one step at a time rather than get my ideas too big. If I take this one step at a time, I'm going to be looking at the top of the spike, looking at the overnight high. I'm going to be looking at half back from Friday, which is also the settle from Friday. So I'm sorry, the settle from Thursday. And then I'm going to be looking at the point of control. Following the point of control, then I will go to the afternoon rally high. Okay, we got a minute to go. One final question.
Does Jim see the top of the spike at 23.25 and not at the L period high where the break began?
I see it at 1923.25. That's what I wrote on the report. And I'm not gonna lose a lot of sleep depending on which one you decide to use. Trading is not a science; it's an art. And I picked the M period high because it broke below an earlier low, but I don't have any problem using the 1926 level. It's just again. Exactness kills. So many times we get too exacting in the market. Okay, so we're open now. What are we going to do now? We're going to look to see how much confidence we have this morning. So the first thing we opened and we trade and we begin to trade higher. The highest confidence market will not come back through that opening. And I'm not saying we're not going to come back through that. I'm just saying that the highest confidence market will not come back through that opening. Okay? We're back to it and through the opening. So we're not dealing with the highest confidence we could deal with here.
Could you make that a little larger, please? Thanks.
It doesn't mean it's not going to be. That's too big?
Just, you want some context, just so people can see the volume.
Okay, how's that?
That's great.
Okay, so now we're looking to seek confidence. And incidentally, for those that are registered for the intensives, The intensive, for all practical purposes, start this Wednesday and Thursday. We're doing 2 pre-intensive webinars for people that are registered on confidence, and it's understanding confidence is a fast track way to get started on it on a day and to keep yourself out of trouble. So they will start. They will be on Wednesday and Thursday. I think it's noon Eastern time. Is that right, Julia?
Yes, noon on Wednesday and noon on Thursday for our European and overseas traders. Better
Okay.
hour.
Okay. So what we've done so far, we've opened, we went higher, we came back to the opening. We're still in the top of the, we're still in the overnight range. The overnight range is, top of the overnight range is always a reference. So it's not the highest confidence market, but we just see as it goes on. We are back into the value area from Friday, which means, you know, we're a long way. When you think how far we've come, this overnight low was at 1893.50, and we're up trading. The overnight high is 28, so we're almost 35 handles. So now the short-term reference point on the upside right now is the overnight high, and that's what the markets shoot for. Markets are very visual the way they trade, and they can see that, they can clearly see that overnight high, and that's what the market's looking and shooting for right now.
Jim, you're not paying attention to, the question is, are you paying attention to the poor overnight high, the matching highs?
The answer is, in a way, yes, because when it went there, I don't spend a lot of time at that because it's not as reliable overnight. But I did recognize that when the market this morning traded back up there, it traded exactly there, then they start to sell it off. So what does that tell me? It tells me that the selling from there was more than likely trading money, not more serious money that was looking for an opportunity to sell. Serious money isn't going to wait till exactly the overnight high. Same concept that we use throughout the day. Do I pay a lot of attention to it? No. Did I notice it? Did I record it? Yes. But it's a good question. Now, this is where it can get really tricky in here. This can be really tough because this market is very, very short. And you picture yourself, but we're already up 35 handles off of the low from last night. So that makes it really tough. But those that are caught short, just kind of picture them hanging on by their fingernails. Are they going to, you know, those that haven't covered, are they going to be forced to cover or not? We don't know that yet, and they don't know it because I'm guessing there's some people that covered overnight. There's an awful lot of people that are still short out there. I don't know what they're going to do. Right now, remember, the confidence isn't the highest we could possibly see. We opened, we went lower, we rallied, we went lower, we came back up, we looked a couple of ticks above the overnight high. There was some immediate sell-off. We're within Friday's range. We're within Friday's range. So this is not an easy, if you're trying to enter the market now and haven't done anything overnight, it's an extremely difficult place to be entering the market. Questions?
Yeah, during a look below and fail trade, do you normally look at the bounce back to halfback as a reference point? I think that's earlier in the session. I don't know if I'm sorry, I can't. Can you understand that, Jim? Do you get
well,
that?
I always use halfback as a reference, just because I want to see what's going on there. If the market stops exactly there, then I had a pretty good idea that I'm dealing with day and short-term traders, and I know these are the people that are the most fickle, and I know the people that can change their mind the fastest. If I don't get to halfback, you know, I'm a few ticks short, and they sell off, or I'm above it and then they sell off, I may have more serious money. Okay, I'm going to go. I'll come back to that in a second. But remember early on, the first assessment I made this morning, we opened, we went higher, we came back, we went higher, and I said, we don't have high confidence this morning, or not the highest confidence. Then we went up, we looked above the overnight high, and no follow through. So what happened? Traders came back in on the sell side. Again, we're getting a lot of chop here. I can tell you that there's a lot of shorts out there that haven't covered yet. Whether they're going to be forced to cover or not, I don't know. But I can tell you there's certainly a lot that have been forced to cover. You also may have some people that weren't short, but they got long overnight. And those people being long overnight, some of those people may be taking profit or may be forced to cover some long, or may be taking profits in here. Again, confidence is low. We saw it from the opening. We opened, we went higher, we came back, we went higher, and I said, we're not dealing with the highest confidence. Confidence will, if you understand confidence, it will go a long way towards giving you confidence, and it will, and you know, adjusting your own confidence, but it will also help you a lot in staying out of trouble. Hold on, I got to put you on mute for a second.
And I get a chance to say something without interrupting you. We have a comment, Jim, when you come back. I wanted to just mention it because this speaks to different trading styles and how aggressive you are. Okay. Our friend in Minnesota, low confidence, but I took a short as we looked above the overnight high and came back in. Not good confidence, but good trade location. And that's from our guy. Yeah.
Absolutely, absolutely. And what I've said so many times, it depends upon your trading personality. If you take that short above there and you're going to hang on to that for dear life, then you probably don't want to do that. If you take that short, it's a very mechanical short, you take that short and you say, okay, what do I need for continuation? And if you don't get what you need for continuation, then you take that short and you cover it very quickly. But again, it's a great trade for one personality. It's a terrible trade for another personality because you cannot get stubborn and you have to be very flexible. We already know that this market is very short. I mean, can we prove it? No, but we can look at the structure, and it's acted this morning just like I thought it would act, you know, based on the point of control not going lower on Friday, and things that happened a few days before. But it's a great trade. It's great trade location. Good trade location. Good trade location is the best risk control that you're ever going to have because you know very quickly if you're right or wrong on that trade. So great trade for the right person. Also, what we're saying, but remember we said confidence wasn't particularly high this morning. So then you got to be a little guarded. When the confidence isn't high, those markets can reverse very quickly. Coming exactly, what is this, 2 ticks above the overnight high? That is not a particularly strong high. It's very mechanical. It's traders that were selling exactly at the overnight high. Remember, longer term money, longer term traders, they have no idea where the overnight high is, nor do they care. But I haven't seen the longer term money on either side of this market.
And as you mentioned that comment about longer term money, we had a question earlier I was waiting on. The volume has not excessively changed since January 1st. So this sell-off is not the other time frame, correct? And we can't see the sell-off. We don't have a daily bar up or your profiles, but
I think I said it earlier, and I wrote in the report, I don't see any indication yet of longer term money in this market. Yes, has volume been up over what it's been for the last several weeks? Yes, it has, but not relative to the volatility. So neither the shape of the profiles, the structure of the market, nor the volume indicate to me that we have longer term money on the sell side of this market.
okay. Thursday and Friday value areas are somewhat overlapping. Is that a balance magnet?
it's I didn't really look at it that way. I just see the trend is down. The trend is down, and Friday was overlapping to lower value, which still conforms to the trend. So I didn't see any problem there. I just saw that the market was getting very short on Friday, but I didn't see it as a balance area. What is more important to me right in here is what I call market completion, or a completion to the existing auction. Now the question is going to become, was Friday's spike the completion to the auction? Or are we only seeing short covering this morning? I mean, we may have only seen short covering this morning. And remember, sometimes if a market gets too short, the market has to rally before it can go higher.
But you mean lower, right? Before
lower, I'm sorry. If the market gets too short, very often it has to rally before it can go lower, because you have to get, remember, anytime people are short, that is potential buying. So sometimes you have to remove that potential buying in order for the market to go lower. Because when the market's too short, every time it goes lower, there's some of these people are buying, trying to take profit. Sometimes you just got to clear them out, then the market can go lower. Okay, so right now, what are we seeing right now? First of all, we saw a professional trader, short-term prop trader, shorting the market at the overnight, two ticks above the overnight high. I think it's a dynamite trade for a short-term day trader. You've got trade location, you know when you're right and you're wrong, and then you start monitoring for continuation on the downside. So far, there is nothing on the downside that says that trade was wrong. Now we'll see what happens. Remember, this market is still very short in here. Okay? But incidentally, that's what short-term trading is about. Short-term trading, and most of our clients are day and short-term traders. Short-term trading is, putting aside your belief on the overall market, really too high or too low. When you're trying to do a short-term trader thing and you're looking at all those kind of considerations, there's a pretty good chance it's going to mess you up. Short-term trading has an awful lot to do with inventory imbalances. Markets get too long, they get too short. They get too long, they get too short. So you really got to make a distinction of what are you actually doing. If you're an investor, then you're looking at the longer term things.
And really, too, Jim, we haven't seen any serious futures price at volume come in yet. And we're used to seeing before any inflection, 10,000, 11, 12,000. It's still relatively light futures volume at price, wouldn't you say? I mean, there's nothing really major yet. We say 9,600 there and a little pop off of it. But usually there's a little more volume. I mean, do you have any, you don't really look at that as much, I guess.
I don't look at it as much. I mean, I'm aware of it. But I'm one of the things that I'm very patient when I'm looking in a morning like this, and I'm very willing to give this market a chance to set up. Now, the trade that was done was a perfect trade. Was an absolute perfect short-term trade. Now you say, okay, but for right now, we're still within the spike. We're still way above the overnight low. We don't have a particularly good high on here. When it goes, 2 ticks above the overnight high, that's certainly nothing to write home about. Right. You need to always get inside the head of the people you're competing against. The money's been made by selling every rally. So I'm not surprised that the very logical thing this morning would be to sell the early rally. And it gave a very logical place is right at the overnight high. And so that's what traders are still doing. And nothing wrong with that. It's very rational. The question is now, are they going to get the downside followed through or not?
Yeah.
But
and we're in the spike too.
Remember what I said early. From the very beginning, confidence was not high. When confidence was not high early on, then the odds are you're going to get more rotation early on. So we opened, showed 1 tick lower, it went higher, came back through the opening, went higher, came back to the opening. So confidence was not high very early on. We're within Friday's range, so we're within balance from the point of looking at Friday. And when confidence is low and you're in balance from Friday, the odds are much greater that you're going to get rotational type of trading. Doesn't have to be, but the odds favor more rotational type of trading.
If the market is too short and we came up from Friday's low, as we monitor for continuation, how do we identify if old business leads to new longs and actual change to the upside begins to occur?
You'll start to see the market one time framing. You'll start to see volume coming in, and
And the
it is something that
confidence.
remember, trading is an art. It's not a science. There's no absolute answers to any of this. Particularly, remember, the shorter the time you're trading, the more you're dealing with pure psychology and the pure emotion of, many thousands of short-term traders, all with many different opinions. They trade every day. Longer-term money may make some adjustments, but they don't make major commitments in and out of markets every day. Shorter-term money, day and shorter-term trading, they're all over the place. Thousands of people, making decisions, a lot of them emotionally based. So it can be very, very tricky. The best thing I find that you start and you say early on, do I have high confidence or low confidence? That's a great starting point for me. Then I look and say, what do I think? Do I think the overall market is long or short? And in this case, I think the overall market is very short. Okay, now, but I have to, so with that, I'm very cautious to be on the short side of the market. At the same time, remember, the trend is clearly down. Unless somebody comes in to reverse that trend, traders are going to do what worked until it doesn't work anymore. What's working for them right now? Selling above the overnight high, selling a rally is what's still continuing to work for traders right now.
Are you still considering this spike as a reference to monitor the auction?
Absolutely.
And so, given that, do you believe that these single prints, there may be too many single prints? We're looking at a 1929 high, 1850 low, so we have 9.5 handles of.
I don't actually know.
Sorry,
Remember,
10.5.
Remember,
Okay.
I tried to caution. Remember, we were 35 handles off of the lows from overnight. I mean, that's a lot. I mean, that's a lot of range. And if you can imagine, there's going to be every emotion imaginable involved in this market this morning. There was options expiration over the weekend. That's going to bring emotion in. There's shorts in the market. There's people that got long overnight. So we're just packed with emotion in here. And remember, the current trend is down. Traders are going to continue to sell all rallies. No, I mean, not every trader, but this is what's worked, and traders do what works until it doesn't work anymore. Now, the basic question was, is this a lot of single prints? Yes, it's a lot of single prints relative to the confidence this morning, but not relative to a 35 handle rally overnight.
Can you explain again why you believe that longer term money are not sellers in here? Like the exactness, maybe, Jim, you could talk about of tagging. Look, in the size, he's new. He's in the intensive.
Okay. I've been in the institutional business for a long time. One time I was with a firm, I raised $80 billion and placed it with, I didn't raise it, my department that I ran raised $80 billion and placed it with money managers. I ran an institutional trading desk. So I have a pretty good perspective on how they operate. And when institutional money comes in the market, you will normally see more volume. You'll normally see smoother profiles. You won't see the herky-jerky nature of it. You won't see the point of control on Friday not migrating lower. If longer-term money was on the sell side on Friday, the chances are much greater that point of control would rotate or migrate lower all day. Because what happens when longer term money is in there selling, they're in there, they're selling, then they let the market settle a little bit, then they come back and they sell again, they let the market settle, meaning, let it rise back up a little bit, and they come in and they sell again. But when the point of control doesn't rise, that more than likely wasn't taking place. And then when I look at the overall volume, is the overall volume high? It's high relative to what we've been seeing, but not for the volatility. But a lot of it has to do with the way the auction, takes place.
And just,
and it's just,
sorry.
They're more consistent sellers. That doesn't mean the markets don't go down very quickly. Okay, now so this market, they're trading, they're selling this market off very hard this morning, from a very mechanical level. What are they trying to get to right now? They're trying to get to the unchanged level from Friday. Value, as we look right now, value will be lower. We're getting acceptance into Friday's spike. I mean, it's early to tell what's going to happen, but we're getting acceptance in the Friday spike. Since most of the activity is down, we're going to look at the volume. The volume, we look at the first half-hour volume. The first half-hour volume the last couple of days has been running just a little under 500,000. That's based on NYSE, New York Stock Exchange composite volume. So since the direction has been mostly down this morning, we'll look at that volume to see what it looks like this morning once we get to the half hour.
And Jim, while we're on overnight, looking at structure and detecting who's in the market, we had a question about anomalies. Could you explain what the anomalies are, what anomalies are? I mean, basically, you won't see as many anomalies when there is longer term money. They tend to be smoother profiles. So just to answer that one.
Okay, first of all, this is the point of control from Friday that's not been revisited was an anomaly. An anomaly is a rough edge where the profile isn't smooth. It loses a lot of symmetry. And again, we're talking about if I have this smoothness of selling that I get if I have longer term money, normally you don't see that many anomalies. We come down and look at Thursday. Anomaly, 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 an anomaly area, an anomalous area. And so again, that more than likely wasn't longer term money. It was probably emotional trading money, and because of just the shape and the anomalies. And you can see we had quite a recovery on Friday, even though the market broke lower. Almost all, but not all, but almost all of those anomalies were revisited. Had this been longer, or repaired, and had this been longer term selling, I doubt that we would have had these anomalies. I doubt that we would have rallied this high.
And if we had longer term selling, I mean, obviously the daytime frame or short-term traders have a lot, you've said larger hedge funds have large pools of capital to trade in a short-term time frame. But a longer-term investment manager like you're talking about, they wouldn't wait for the overnight high to be taken out by 2 ticks to put on some huge size. It just doesn't work that way. Their size doesn't allow them that type.
It's just not rational. It's just not the way they operate. It's just understanding behavior, people. Now, this is pretty heavy selling in here this morning, pretty consistent selling. But notice that one trader that took this is an absolute perfect trade. This is how we use references. And then you say you monitor for continuation. If you go short here, what's the next thing you want to do? You want to get down below the base of the spike. You get down below the base of the spike, the next thing you want to do is you want to get to unchanged from Friday. And all they're doing, and really what the market's doing right now, they're just going with the trend. The trend has been to sell every rally. Traders will do what works until it doesn't work anymore. Okay, I'm going to take a look. We've got 5 minutes until the volume changes. But I'm going to go over and I'm going to take a look just to get an idea where we are. I'm going to our site. Go to our site and you see NYSE volume. And so far we've got 394,000, and we've got 4 minutes until we change periods. That is not particularly strong volume for how much this market is off this morning. That's not heavy volume at all. Remember, we've been running, we'll look here in 4 minutes, but we've been running about 485, just slightly under 500,000 for that first half hour. So what I'm guessing in here this morning, again, if you didn't have any longer term buying in here, or you wouldn't be down here, but you didn't have any longer term selling. If you had longer term selling, when you're really serious money, I think your volume would be much higher. I think one more time, we're seeing short day and short term traders doing what has worked. And what has worked is to sell all rallies, and this gave them a perfect reference, and the perfect reference was at the overnight high. Traders love to use very visual references. And I'm saying that, very visual references versus mathematical references such as Fibonacci and Bollinger Band levels, moving averages, etc. They tend to, for the shorter the term trading that's going on, they tend to look very closely at very visual, easy to identify references.
Also,
question.
Yes, thank you, Jim. Also, the cognitive dissonance, he's commenting that lately the E-mini, the S&P, and the stocks fall as crude falls, but attempts to climb, gets a relief rally when crude slows, or stops falling. Do you have any thoughts on this? And crude is, below the 33.
Yeah, crude was down. Crude was down 3%, overnight. So there's no relief in crude. You got people out there this morning talking about $18 crude. So, and again, this is traders, short-term traders. They'll generally take the easy route. And the easy route is, okay, the market's been off, crude's off, let's sell the market, and that works for a period of time as long as you know that you're dealing with fire and you got to exit very quickly if that changes, or if in fact the market will stop looking at that, and there'll be a point in time all of a sudden the market will stop looking at crude. It won't care. Very, very strange. Okay, so now we're continuing to sell off. Probably some is just people, because what has worked, they're just doing what has worked, very rational. You probably got some people long overnight, and you got some short covering overnight, you got some people long overnight. And what we're still within Friday's range. We're still within Friday's range, and we're going to change time periods here in just a minute. And as soon as we change time periods, we're going to go out and we're going to take a look at the volume. And if volume is under about 450, that tells me there's not much selling in here. 485 or so would be about what we've been seeing. Start getting over 500, that's pretty high for what we've been seeing. Okay, so we've got seconds left. I'm going up. I'm going to check the volume. Okay, 444. Volume is going to be less than it was on Friday for the first half hour, so it is not particularly strong volume this morning. Okay, this is what we said we'd do as an introductory reference. The webinar this morning, and it's worked fairly well because you've seen it go to a very visual level, still within Friday's range. And this is what we're going to do as we go through the intensives. We're going to be out there, and every morning, almost every morning, we've got a early morning seminar to kind of give you some perspective. Then throughout the day, I will make chat comments to guide you. For example, one of Friday's chat comments might have been, watch the point that we're one time framing lower. Don't overlook that. And that's important because it's really easy to overlook. So the intensives really kick off this Wednesday. They kick off, they officially start on next Tuesday. But we're going to do the two intensive, the two confidence sessions on Wednesday and Thursday. And it's really important. So many times people think, though, if they go to see a psychologist or something, it'll help them deal with some of the psychological issues. It's very difficult to deal with some of the psychological issues we have in trading unless we have a really solid understanding of how the market functions first. If we understand how the market functions, I think you will be absolutely surprised how many of what appears to be personal psychological issues go to the wayside. The market confidence and your confidence are closely tied together. Julia has put out a schedule. I think what is there, 51 sessions throughout the first intensive, Julia?
Yes.
Okay, and those are posted now. Anybody can look over and they can see those schedules.
I think if they can see it here too, I dragged it into the handouts part of this presentation, so they hopefully can grab them here. Okay. I got a question too when you're ready, sir.
Let me make one more comment. Okay, so now when we came down, we did not, we said volume wasn't that high this morning. The overnight high served as our first selling point. We said that is not a particularly solid high because longer term money doesn't even know where that is. So more than likely that was trading money. Now we've got a little buying tail down here. Now the market is rallying. Your next upside rally reference point is going to be the the halfback. And halfback is, what is that price, 1920 something?
21, relative close.
Yeah, it's
21.50, right near the high volume node.
Yeah. So that's going to be your next upside reference. Then you're going to look to see, do we gain short covering? You're going to look to see, do we one time frame up or down? These are the kind of things you're going to look for. You're also going to remember we are still within Friday's range. It's somewhat negative this morning because as of this point, volume is going to be lower. As of this point, we are getting acceptance in that a lot of that lower spike from Friday. It's a little earlier to say what the total day is going to look like, but those are observations. Julia, you were going to say something, or you had some questions.
Yes, thank you. Would you watch, he asked this more when we were at the lows, would you watch for failure to take out unchanged, the settle from Friday, and trade to the upside supported by the low confidence, and I would add the single prints? Or is that trading against the prevailing time frame traders, the day and the short term, who are selling it off?
No, the unchanged is a very serious reference for day and short-term time frame traders. And so, I mean, the market tried to get down there. It didn't even come close. We got a bounce. The bounce did not make it to half back. And now, so far, the B period or second period bar, it's very early. It's inside the A period bar. And, you know, there were a lot of single prints. So what you're going to look to see now is if you were wanting to go long, this was a legit long down here, a legitimate long with a, stop. You don't want to see it to go to unchanged. If you want to be on the long side, you want unchanged to hold. And you want to start to see some upside continuation, which you're not seeing yet. You want to see upside continuation. You want to get to half back. You want to get above half back. Then you want to get back above the top of the spike. So it's so far this morning, we're within Friday's range. The market sold off. It did nothing different than what it's been doing for some time. They were selling every rally. Value is going to be lower as of this point. That can change, but you didn't get to unchanged. So far, there's nothing that says, wow, I really want to be on this market on the long side for a short-term trade. Doesn't mean it's not there. Do I think the market's short? Yes. Do I think we could get a short covering rally of some magnitude? Yes, I do. Do I think I need to do that right now? No, I don't. But it can change very, very quickly. But the point that we did not go to unchanged um, certainly has to be a consideration on this market. The fact that it's very short has to be a consideration.
Mm-hmm.
Okay?
Okay,
And
thank you, Jim.
incidentally, if you wanted to go long, this is exactly down here. I think options are, if you're looking at this breaking, I still think the market's short. And I think this is a great place to use options. Because if it works against you, it's going to get hurt. But when you're trading in futures in this kind of volatility, it can get really scary sometimes. And you get a spike down that it doesn't actually take out the low, but all of a sudden you start getting worst case thinking. The options give me a little bit more, they make me a little calmer. They give me a little better sense. I don't feel quite the sense of urgency that I have to make these constant instantaneous decisions. Okay, other questions or comments you have, Julia, before we leave?
Yes, thank you, Jim. If Jim is using the New York Stock Exchange volume, why isn't he looking at the 4 p.m. close? I mean, we bounced right off of that 1914 area. That is when the SPX went to unchanged. So, yeah, he's saying the 1914 area, that was the 4 o'clock close. And why don't you use that? You could have that as another reference, especially if you're trading the SPX and not the futures.
What was the 4 o'clock close?
14 area. And we bounced close to it before reversing. That was unchanged.
Well, the M period low was 1910.
But where M period closed would have been the New York Stock Exchange cash close. That's his point. It must have closed around 14. So he's just saying that reference would have helped with today, and you use the volume from the New York Stock Exchange, but you don't use the close from the New York Stock Exchange. So just asking, it's a different, you can have that reference up on your chart. Nothing stops you from looking at that as well.
It's not something so many times it's not something I look at the low. And maybe I'm not totally appreciating the question. I'm looking more at the low rather than the close. Okay. Final question?
Yeah, if you would you enter the market after hours, for instance, Sunday night, and he missed it earlier, but yes, Jim bought calls overnight, and versus waiting for the pit session.
Oh yeah, I mean do I like trading overnight? No. Do I use it from time to time? Yes. If I think it affords me an opportunity, absolutely. But I would certainly rather do it with options than I would rather do it with futures. There's a lot of volatility, and the markets are very thin overnight.
Thank you, Jim. And when Jim talks about the options, he's trading the E-mini S&P futures options right here in this market, the weeklies most often.
And one of the reasons it's very easy that I can trade the options 24 hours a day. I trade options 24 hours a day, as long as the electronic sessions are open. And I get the bid and the offer, and I can put my prices in where I want them, and it's not very difficult for me. I never would use a market order, but I can see the bids and the offers. All right. Well, let me say thank you for both of us. If you're thinking of the intensives, of joining us for the intensive, and you haven't joined us yet, you want to get ready because you want to be there for the Wednesday and Thursday confidence sessions. They really will help build the foundation. A last comment I'll make: this is where it can be tricky sometimes. You get a test of the low. I mean, look down here, and I could find myself going, "Oh, are they going to take it?" And all of a sudden, it reversed pretty quickly out of here. It can very, very tricky when you're down here. I mean, it looked like, oh boy, and price can mislead you sometimes. And I'm looking back and saying, okay, make it happen. Don't lean into the wind too much. All right. If there's anything anything here, we'll start one time framing on the upside. We will get back above the spike, and we'll get back to the early morning high. There's anything on the upside. We're going to the downside. We'll come B period is kind of balancing for 10 minutes. We'll trade to the downside. We'll get to the unchanged level, at the 1911, and we start to get back below Friday's low. So those are very important references to keep in front of you as we go through this morning. Also, remember to keep an eye on one-time framing. Okay?
Yes, and Jim, the person who took the short this morning, would his target be unchanged, or would you be looking for something else?
No, I wouldn't have a target. I'd be monitoring for continuation.
Slide that down so they can see at least where we're talking about.
Okay, so they got short up here, and you're monitoring for continuation, and everybody's going to do it on your own way. And I don't know where you would come out. And remember, you've got other choices. You can just come out of that. Let's say you bought 10 puts there. Now you could come out of 5 up. You could go long some futures down here when it's pushing on the lows, on some mix, say 3 or 4 futures versus the number of puts. There's a lot of different things you can do. Everything we do in the market doesn't have to be black and white. However, to go more specifically, if fairly quickly the market doesn't get to unchanged relative to Friday, then you've got to be very careful that a short covering rally doesn't get underway. All right?
Yes.
Thank you very, very much.
Okay, Jim, thank you very much. And everyone, early registration for the intensive ends this evening, midnight. Okay, so you can still be in on the early reg price. And also, we are going to have the market confidence webinars on Wednesday and Thursday. A lot of traders are asking, are they going to be recorded? Absolutely everything for the intensive is recorded for easy access. Okay, so if you do miss the intensives and you sign up late, those will be at the training site for you to watch.
But they're only the Wednesday and Thursday webinars are only available for intensive clients.
Yes, and Jim has said many times, that it's a fast-track concept to learn about market confidence. It can be a great trade filter, put expectations around how much we press our trades if we're in one, and also just helps us calibrate odds of continuation to the upside or the downside. So I think that's going to be a really cool webinar series, and we're going to talk about that throughout the intensive.
Yeah, and remember what I said this morning. We don't know what's going to happen before the day's over, but we said confidence was fairly low from the opening. We opened, we went higher, we went lower, we went higher, we went lower. We said confidence was fairly low early on. If confidence was high, the highest confidence, you open and you move directionally. We said because confidence was relatively low, that increases the odds that we get rotation throughout the day. Okay? Once again, thank you very much.
Okay, great, Jim. Thank you very much. And everyone, thank you for being here. Thanks for your time. And we'll have this recording up in about an hour. If you have any questions about the intensive or any questions that you didn't get answered here, please email us or give us a call. Okay, and our number and all is at the website. God be with you. Have a great week. And maybe we'll see you back for the market confidence webinars if you're signing up. All right. Goodbye.